Welcome to the AGORACOM Online Gold and Commodities Conference. My name is George Cholis, founder of AGORACOM, and I'm pleased to have Dr. Paul Kedrosky with us today to shed some light on what to make of today's bipolar markets. Paul is an investor, writer, entrepreneur, and a sought-after speaker, so we're especially fortunate to have him here on AGORACOM. Specifically, he's an analyst for CNBC Television, a columnist for The Street and Real Money, and the editor of Infectious Greed, which was named one of the top 3 business blogs in the world in 2008. He's frequently quoted in major publications, including The Wall Street Journal, The Economist, Harvard Business Review, and others. He's currently a senior fellow at the $2 billion Kauffman Foundation and a senior research advisor to 10 asset management and institutional money management firm using innovative quantitative techniques in capital markets. He's also a fellow on the advisory board of the Berkeley Center for Innovative Financial Technology and an advisor to various other companies, institutional investors, and venture capital firms. He was a former venture partner at Ventures West, a large institutional venture capital firm, and most important of all, a fellow Canadian who earned his degrees right here in Ontario, Canada. Paul, welcome to the conference.
Hey, George, great to be here.
All right, we're truly going through unprecedented times in which investors at all levels are having a difficult time figuring things out. So specifically, over the last 12 months, we've seen surging sovereign deficits, unemployment, skyrocketing gold, unprecedented government spending. But on the other side, we've got historically low interest rates and North American stock markets that have gained more than 50% in 9 months. So help investors reconcile this. Let's spend a little bit of time on how we got here, but more importantly, I think people really want to hear from you as to how this is all going to turn out.
Sure. So, yeah, as you say, I think most people, unless they've been hiding under their beds for the last 18 months, have a pretty good sense of how we got here. But obviously the short version is that we had an unprecedented sort of twin bubble in the U.S. and worldwide, quite honestly, and most of which was built around the accumulation of significant amounts of debt, both at the governmental level as well as at the individual level, with the upshot being that we had this unprecedented and frankly epical level of debt across the U.S. and largely across developed economies around the world. And, you know, most people will have seen sort of the famous chart showing sort of debt to GDP as this giant sort of cyclical relationship since the Great Depression up until last year, where we hit levels that had never been seen even during the Great Depression. And
right.
once that sort of whole edifice came apart, which it did whenever we had for the first time in modern financial history a run on the wholesale banking system. You know, historically we've had many runs on the retail banking system, that is individual creditors giving up hope on banks and trying to en masse withdraw all their money. What we'd never had happen in the modern financial system, which is much more built around a wholesale funding model than a retail funding model, was the mass search for liquidity by wholesale investors, which meant in the money markets and repo markets and elsewhere, all of a sudden everyone at simultaneously losing confidence in the collateral on the other side of those financing trades and walking away. And once that wholesale market dried up, bank solvency tumbled shortly thereafter.
So is it safe to say that there wasn't really a game plan for this scenario? So in response, we've got G8 governments are simply printing money, keeping interest rates low. The result in the short term has been a nice appreciation in the stock markets, but is that the solution? Have they found the solution? Do we simply print our way out of it, or is this short-term gain and we're in for significant problems down the road?
Yeah, so a bunch of questions in the question. So first questions first, I guess. You're right. There was no game plan here for a bunch of reasons, some of which the entire economics discipline should be incredibly embarrassed about, not least of which is that the discipline had fallen into the comfortable habit of tracking the wrong measures, and most specifically simply tracking the sort of the orthodox money supply rather than worrying about credit creation in the economy writ large. And that's because there had been this ethos taken hold that said we don't worry about bubbles, we just clean up in the aftermath, and that was convenient, pat, and frankly dangerous and silly. And we're now living through the consequences of having ignored the growth of credit in the economy and now having to clean up after the mother of all credit bubbles and mop up the pieces. So there was no game plan to deal with what happened in the consequence of not just a small credit bubble or a small asset bubble, but the largest such credit bubble in the history of sort of modern capital markets. And so having said that, everything that would happen last September, last August, from sort of the nationalization of Fannie and Freddie through AIG, the failure of Lehman, and into the fall, was all completely seat of the pants. And so, given that it was seat of the pants, we shouldn't be particularly surprised that an awful lot of it, frankly, wasn't very effective. The problem, of course, was, in the alternative, what would have been a better solution? Well, it would have been a better solution in many ways to let many of these companies and institutions fail. I think that's also pat and convenient, because the problem is, as I like to say to people, and I don't know if you have kids, George, but I mean, my kids love, the sort of this idea of sort of outer space aliens, and what would happen if we just let everything fail is kind of like what would happen if you sort of have to sort of abandon the planet and wander off and come back again and say, what did things look what things need to look like before we can come back and safely inhabit the planet. And so if you let all the major institutions fail, in many ways that would have been a great idea, but the trouble is the planet is inhabited, and given that the planet is inhabited, we couldn't let all the major institutions fail. And so once you do that, what happens is you're now transferring all the debt and all the credit that was sitting on private sector balance sheets, whether corporate or individual, over into the public sector balance sheet. And that's orthodox in many ways post-catastrophe Keynesianism, and that's what happened. The trouble is that the levels of debt have gotten so high that that's now causing, has sovereign consequences for many of the countries, replacing the consequences for the individual companies. And so that forced the printing of all of this money to try and deal with the transfer of all the liabilities from corporate and individual balance sheets onto the public sector balance sheets, because we refused to let all these companies fail. This isn't Wall-E, this is real life. We couldn't all sail off planet. And given that, we were sort of backed into the situation of trying to save, frankly, too many things because we didn't know what to save. So the answer is that no, we're in for a long cycle world of pain here, because the most optimistic scenario from the standpoint of what we've done is that we sort of muddle through much in the same way that Japan did, has, frankly, because they've never really truly recovered from their own credit episode in the 80s, and we see a decade or more of high volatility, a great deal of uncertainty about the viability of sovereigns and their associated fiat currencies, and that plays out over the course of a decade or more as this gigantic process of deleveraging rolls on and on and on.
Now, isn't it true that Japan was able to stay afloat because they were able to export into a pretty strong global economy, and they were able to stay afloat that way? But in this case, you can't have half the developed nations pursuing that same strategy. So can we actually repeat Japan, or in fact is it going to be worse because there's no growing economy to sell into and export into?
Well, there is, and there is a growing economy to export into. The trouble is that I'm not particularly confident about the prospects for it. And the growing economy that in the perfect world replaces the U.S. as the quote consumer of last resort